Hi, my name is Ray.
Hi, this is Michael.
Welcome to our episode of Ray's Economics Cluebook. Today, we're talking about the foreign exchange market and in terms of economics. So let's first look at what exactly we do in a foreign exchange market.
Yeah.
So foreign exchange market is all about the market for a single currency, for instance.
Yeah.
For instance, look at the U.S. currency.
Yeah.
U.S. currency, of course, we look at a market, we'll have the price and the quantity. The quantity U.S. dollars and the price of U.S. dollars. Now, the price of U.S. dollars has to be measured, and it has to be measured not in US dollars because that doesn't make sense.
Not.
It has to be measured in another country's currency. So in this case, let's say British pounds.
Yeah.
So basically, we look at the price of US dollar in British pounds compared to quantity US dollars, and the price of US dollar compared to British pounds is then the US dollar's exchange rate compared with British pounds. So let's say 0.64 means that $1 you could trade in for 0.64 British pounds.
Yep.
And so basically in the market, how the supply and demand could shift. For instance, if U.S. dollars get cheaper compared to British pounds, then that can then lead to a secondary effect where U.S. goods and assets are now cheaper compared to the British pound compared to the people, relatively speaking. So people in Britain will then be able to afford more U.S. goods.
Exactly.
Therefore, they will demand for more U.S. goods. And to buy U.S. goods, they can't buy it with British pounds; they have to buy it with U.S. dollars. So demand for U.S. dollars increase, and then the exchange rate then goes up, secondarily speaking.
Yeah.
And then the counterexample, basically, if the dollar gets relatively stronger compared to the British pound, then the opposite happens. British goods become cheaper to U.S. citizens or U.S. dollar holders. So they will convert their U.S. dollars to more British pounds to buy British goods. And to convert the U.S. dollar to British pounds, they must sell U.S. dollars and buy British pounds. Selling the U.S. dollars creates an increase in supply in U.S. dollars, which then decreases our exchange rate subsequently.
Yeah. So in summary, basically, we are talking about how demand and supply in this foreign currency is just like a traditional, traditional goods like a coffee or teas.
Yeah.
And so basically, it's demand for U.S. dollar basically equivalent to demand for U.S. goods and service.
Yes.
Right. Supply of U.S. dollar, of course, only Americans they can supply U.S. dollar, right?
Yeah.
So the supply of the U.S. dollar usually connected with a purchase of foreign products and foreign service.
Yes.
Okay. Yeah.
And so basically, there are also other more outside effects that can cause changes in foreign exchange or forex.
To shift the curve.
One thing is a change in taste. Let's say British tourists now have a change in taste and they want to flock to the U.S. and tour in the basically vacation in the U.S. more.
Sure.
Well, to vacation and temporarily stay in the U.S., you can't buy. You have to convert your British pounds to U.S. dollars.
Yep.
And so this causes the demand for U.S. dollars to increase, which causes a shift to the right in demand for U.S. dollars, which causes an increase in U.S. dollar interest rate or exchange rate.
Yeah.
However, subsequently, this is matched conversely by a supply of British pounds increasing and the supply of the British pound shifting right, which decreases the British pound exchange rate, and to match the increase in the exchange rate in the dollar.
Yeah.
So the dollar appreciates and is matched by the pound depreciating in this example of changing in taste between Britain and the U.S.
Exactly.
So you see here, the dollar appreciates, the British pound depreciates.
Yeah.
A second way that the dollar or exchange rates can be changed is basically strategy, investment strategy.
Based on the interest rate difference.
Yes. So basically, let's say you have a low interest rate country and a high interest rate country.
Like Japan.
So like Japan and Austria.
Yeah.
And so Japan obviously known for its low interest rates, to say, then people holding Japanese yen, investors holding Japanese yen, they want to loan their currency in a country where they can get a high return back, meaning a high interest rate back.
Yeah.
And so why would they loan to a low interest rate Japan when they could convert their yen to Austrian currency?
Australia. So basically, it's Japanese. They will supply a lot of Japanese yens.
Yeah.
And they by supplying a lot of Japanese, they convert it to Australian dollar.
Yes.
So the Australian dollar demand increase.
Yes. And so basically, why would they loan to low interest rate Japan when they could loan in high interest rate Australian dollars? And so they will convert the Japanese yen to Australian dollars, and the supply of Japanese yen then increases, which decreases its fixed forex rate, and the demand for Australian dollars increases.
So basically, it's Japanese yen will depreciate.
Yes.
Australian dollar will appreciate.
Yes.
Okay.
And so finally, we have political instability, or just currency instability can cause a lot of issues. Let's say 1986-87, Mexico had very high inflation and it was very unstable politically, economically. And so what happens is, obviously, the demand for Mexican dollars will decrease because super high inflation and instability is not something people will invest in.
Absolutely,
So less people will demand, less foreigners will demand Mexican pesos.
Shift to left.
However, those holding Mexican pesos, they were holding unstable currency. So even those in Mexico who hold Mexican currency, they might not want to hold their savings in such an unstable peso. They might want to convert that to a more stable dollar or the US dollar or something else like that. They hold their savings and assets in that. And so they will sell their Mexican pesos to buy other more stable currency. So the supply of Mexican pesos increases while the demand decreases, obviously, which causes a rapid decrease in the exchange rate of a peso.
Yeah, so the peso price decreased from $2.5 to $0.5. It's today it's unimaginable because today is in 2019 the one Mexico peso is only about 5 cents.
Yes.
So you can see it's from 2.5 decreased to 0.5 then 0.05.
Yes.
So
for our final clues, foreign exchange can be driven by multiple factors, mainly change of taste, interest rate difference, political instability, and other more perhaps
external
more
factors.
And external factors. But overall, we can see exchange rate is something that may seem complicated at first, but when we dig into it, we can see there are mainly a few factors mainly driving it.
Okay. So next time we'll discuss more, external factors. So see you guys.
Okay.
Bye.